Welcome everyone to this explainer. I am absolutely thrilled to have you here today because we're going to tackle what is literally one of the most frustrating, account-draining experiences in modern trading. Seriously, especially if you're trading highly volatile markets like Bitcoin or gold, you know the exact feeling I'm talking about. You spot this absolutely perfect setup. The price violently surges past a massive resistance level, you jump in, and then, almost immediately, the market just aggressively reverses right in your face. Well, today, we're putting a stop to that. We're going to master advanced breakout filtering, and you're finally going to learn how to escape the dreaded liquidity trap. 89%. Think about that number for a second. According to industry estimates, anywhere from 70 to 89% of retail investors lose money in the markets. I mean, that is just a staggering statistic. And why does it happen? Well, the main culprit actually isn't a lack of effort. It's that traders are constantly falling victim to false market signals and, frankly, poor risk management. You see, they aren't just losing trades. They're actively being hunted in what we call liquidity sweeps.
Okay, let's dive into this. Here's our roadmap for fixing this mechanical failure in our trading. 1. The breakout trap. 2. Anatomy of a fakeout. 3. The multi-filter framework. 4. Optimal entry strategies. And 5. Mastering risk and psychology.
Section 1. The breakout trap. Let's start by understanding the battlefield. Fundamentally, a genuine breakout happens when the price of an asset finally breaks through a significant historical support or resistance level. And crucially, it does this with a massive surge in volume. Whether you're trading tech stocks, wild commodities like gold, or digital assets like Bitcoin, a true breakout represents a real shift in the balance of power. It tells us, hey, demand has definitively overwhelmed supply at this key threshold. A brand new trend is being born. Remember, true breakouts are about a structural shift in the market, not just one single, flashy impulse candle. But here's the ultimate enemy of the retail trader, the fakeout. You'll also hear this called the liquidity trap. This is when the price briefly pierces that key level, looking exactly like a breakout, but it's a complete illusion. It triggers this massive cascade of stop-loss orders from early traders and then leaves behind nothing but a long wick on the chart before snapping aggressively back into the previous range. It is a classic stop hunt. It's absolutely brutal, and it's the exact reason why highly volatile assets can be incredibly dangerous if you don't know what you're looking for. Section 2. Anatomy of a fakeout. Why do traders keep getting trapped? Now, what's really interesting here is the sharp contrast between amateur, impulsive entries and professional, calculated trades. A real breakout, it's fueled by high volume. We're talking significantly higher than your standard 20-period average. It has a strong, definitive candle close, and it perfectly aligns with the higher time frame trend. A fakeout, on the other hand, well, it happens on really weak volume. It usually shows momentum divergence on indicators like the RSI, and it features a rapid, almost instant reversal. It's a structural difference, and you can spot it a mile away once you know the signs. And here's the invisible, behind-the-scenes mechanic of the market you absolutely have to grasp. Where do you think major institutions find the immense liquidity they need to fill their giant positions? I'll tell you, it's sitting right above resistance and right below support. It's your stop-loss orders. Institutions will actively drive the price past these levels to orchestrate what's called a spring or a stop hunt. They grab all your liquidity, fill their own massive opposing orders, and leave retail traders holding the bag in a devastating fakeout. Section 3. The multi-filter framework. So the crucial point is, how do we build a defense system against this? I really want you to treat this strict 4-step checklist like gospel. First, always check higher time frame alignment. I mean, a 15-minute breakout is totally useless if you're fighting a massive 4-hour or daily downtrend. Second, verify the session context. Third, and please don't skip this, wait for a definitive, strong candle close to confirm the level is actually broken. Do not trade the wick. If the body of the candle doesn't close over the line, it is not a breakout, period. And fourth, validate the whole move with volume expansion or a volatility tool like the VWAP or ATR. The impact of applying this framework is honestly staggering. Hard data from advanced breakout trading models shows that applying just one of these filtering rules can dynamically eliminate up to 80% of losing trades. Take a second to process that. Imagine just waving a magic wand and cutting 80% of those brutal false entries out of your trading life completely. Let's look at a very specific, real-world application using just the session context filter. Before you take any breakout, simply ask yourself, is the market already moving in my intended direction today? When researchers applied the single zero-parameter rule to a raw E-mini NASDAQ breakout model, it drastically smoothed out the equity curve. Whether you're trading the NASDAQ, gold, or Bitcoin, this works because it forces you to align with the day's true momentum. It instantly filtered out false breakouts and bumped the profit to drawdown ratio from 5.24 up to nearly 8. That's a game changer. Section 4. Optimal Entry Strategies. Let's shift gears and talk about actually executing the trade. First things first, we have to identify the visual geometries, the patterns where market energy literally compresses right before a major explosion. Rectangles show us periods of consolidation trapped between flat horizontal lines. Triangles show price tightly compressing, which signals a massive continuation of the trend is imminent. And then you have patterns like the head and shoulders, where a neckline breach indicates a total market reversal. Recognizing these specific structures allows you to anticipate exactly where the springboard is located. Let's move on and see how this builds our actual execution timing. You generally have two choices here. The first is immediate execution, where you aggressively enter the exact moment that session candle definitively closes beyond the breakout level. Or you have the much safer and honestly superior choice for most traders, the pullback and retest method. Instead of chasing that initial explosive move, you patiently wait. You let the price pull back to test that old resistance and confirm it as brand new support. This retest method is absolutely crucial for wild assets like Bitcoin or gold because it gives you definitive proof that the trap wasn't just sprung on you. Furthermore, timing is literally everything. A weak breakout in a quiet, ranging market is almost always a trap. You want to maximize your efficiency by trading strictly during high liquidity kill zones. We're talking specifically about the overlap of the London and New York Opens. Trading during that dead time between major global sessions usually just results in erratic, low-volume price action. And trust me, that is the exact environment where fakeouts absolutely thrive. Section 5. Mastering Risk and Psychology. Because at the end of the day, protecting your capital is the only thing that keeps you in the game. Let me be perfectly clear about something. Even if you filter your setups flawlessly and execute like a machine, you are still trading probabilities, not certainties. And that demands ironclad risk management. You have to place your stop losses logically beyond the fake breakout zone, usually tucked safely below the most recent swing low, so you don't get stopped out by just normal, everyday market noise. Use trailing stops to ride those massive trends. Base your targets on the actual height of the preceding pattern. And this is vital. If you're trading highly volatile markets like crypto, your stops naturally have to be wider, which means you absolutely must reduce your position sizing to keep your total account risk constant. The entire professional mindset can basically be summed up in one simple phrase. Your first loss is your best loss. Look, failed breakouts are still going to happen. When the price breaks right back into the previous range, the setup is officially dead. The professional response? Cut the trade instantly. Amateurs hold on, they pray for a miraculous reversal, and they end up entirely destroying their accounts. Just cut it early. Finally, you have got to eliminate FOMO, the fear of missing out. It's like a psychological virus. We've all been there, right? You're watching this massive impulse candle just tear away, you start panicking, and you click buy right at the absolute top. Well, by the time you enter out of FOMO, the smart money is already taking their profit. They are selling to you. Never, ever chase the price. Wait for the proper setup or simply wait for the retest. So, I want to leave you with this challenge. How many times have you been trapped in a fake out, just helplessly watching your stop loss get hunted right before the market moves exactly where you predicted? Take this multi-filter framework we covered today. Choose just one rule, whether it's checking the higher time frame or just having the discipline to wait for a strong candle close without wicks, and actively apply it to your very next trading session. Protect your capital, escape the liquidity trap, and I will see you in the next explainer.